Welcome to First Funders. Today we have Sundeep Ahuja, a longtime friend. I've been having a few old-time friends in the recent past, and Sundeep is now another one that's joining in, who we can go way back into time. And I'm excited to share and hear more about his investing journey because it's in some ways similar to mine, but in many ways very different. Sundeep has been a founder, an operator, and an investor, but here's how he's different. He's also been an actor and an author. And that is the time that I met him. So he was switching around from eBay to becoming an actor in LA. And I was like, who is this guy? What is he doing? And then before I knew it, he was back in tech starting a company. And then before I knew it, he was making investments into all sorts of founders. He has probably made more investments into more sectors than any other person I know, but now has a huge focus on climate and has for a long time. And it dates even back to his roots with his family, which is really interesting. And so we have a really unique person on the pod today and someone who has been also part of my journey in becoming an investor, which we've talked about on the pod, but we can bring up again. So with that, I would love, Sandeep, to share a bit about yourself and share a bit about how you switched from all these different things into becoming the person you are today as a fund manager.
Yeah, thank you. First off, just delighted to be here. And yeah, we do go back and had the honor of recruiting you to be one of the founding partners of DVC. And that was a beautiful moment and just allowed us to collaborate. So thanks for then and thanks for now. Yeah, where do we start, right? We can have the half-hour version or the sort of, 1-minute version. I'll give you the 1-minute version. Went to Stanford in computer science and, the 99, 98 timeframe and sort of got, enamored with tech. Graduated into a market that was not very attracted to it. A lot of startups failing, so I went banking. But I was like, I still wanted to kind of be on this in the tech world. So then ended up joining eBay for a while, and I'd had this sort of flirtation with acting, and decided after being at eBay, I was like, all right, I think I know this is what I want to do for my life. Well, I'm still kind of youngish, so I'm gonna go do something fun. So I went to LA, and it was, I am on IMDb. I've been in a couple of TV shows, and there's part of me that still wants to return to that world, but while I was
Wait,
there,
you have to tell us what shows you were on because it's fun to know.
yeah, Entourage, How I Met Your Mother. I was in some ads like State Farm and Microsoft and stuff. So it was good times. Dance video, which is probably the highlight. Shooting that in Beverly Hills at a mansion, so much fun. But yeah, then I was at MySpace for a while doing product, and that's when I started realizing I wanted to kind of really get back into putting on my founder hat and left to co-found a company with some friends. But along the way, I joined Kiva.org as just one of the first people on the team. And that was truly life-changing. That was where I was like, oh my gosh, I want to be the intersection of tech and impact. And while I was kind of figuring out, okay, poverty is obviously this massive issue, but what's my issue? What's my calling? I realized it was climate. My dad, put into family, spent 40 years working at California as a resources board. And of course, he wanted me to be a doctor, but he was out there, helping us breathe cleaner air. And so I'm camping as a kid and backpacking and just had this affinity to climate. And I realized, working in climate, this is back in 2007 when I was trying to figure out what I wanted to do. Even though I was co-founding this other company, I realized it wasn't my thing. I was like, climate's going to make everything worse, right? Like climate's going to make poverty worse, which is the issue I was working on with Kiva. Poverty. It's going to make health worse. It's going to touch all these things. So when I was thinking about what I was excited about, it was not only just that, impact in tech, it was also like how much it was touching everything I cared about. So that's when I decided I wanted to work in climate, left the first startup, co-founded another startup, left that one after some co-founder drama and finally found, okay, now I think I can work in climate and started a company to introduce people to more sustainable and less toxic products, which for a while we were like, number one at what we did and it was great. I realized it wasn't venture scale and turned into a side business, but I was still, one thing I realized in that is like, wow, no one really cares about climate. When we marketed things as sustainable and nobody cared, we marketed as non-toxic, people cared, right? Of course, people care about themselves first, and I did too, frankly. But I was like, there's still this important issue we have to raise awareness about. So I wrote a novel about a post-climate change future, and it's so fun. Recently, like a month ago, Amazon let me publish it into Audible using their sort of AI. So I'm listening to it for the first time in 12 years. And I was just telling my wife this morning, like, I'm at the part in the book where I'm so enthralled. I wrote the book, but I can't put it down. I literally had my phone in the shower this morning playing it, then my earpod in while I was making oatmeal, listening to what's happening next. And it's just fun, right? Yeah, I know what happens, but it's still so fun. We had a nonprofit we co-founded called Silicon Climate, where we're accelerating companies that are now unicorns. We went to the Maldives to shoot this pilot about the rising sea levels called Last Glimpse. I'll circle back to that in a second because my collaborator there and I are reuniting. And then So I started doing a lot in climate, and at the time started investing. I was early to AngelList's platform. They had this thing called syndicates that they launched, and then Unival, and he was like, I want to be the impact syndicate guy. And he's like, dude, just bring me deals. We just launched this thing. So I was like, all right. So I brought two of the first few deals. And it was funny because I did that, and he had like Tim Ferriss bringing him deals. Like he had like names, but in this Fortune piece that he was talking about, he was like, Sundeep Ahuja is bringing deals. And the reason he said that is because like no one knows who I am, right? And the point he was making is you could be a nobody bringing deals. He didn't name drop Tim, but I'm grateful for it because after that I was in business. After that, people were like, "Oh, Sundeep's investing," and I got LPs, I got deals, and I was sort of off to the races. And climate wasn't an investable category back then, so yeah, to your point, I was investing in a lot of different areas and enjoying it. So anyways, fast forward, I needed to get a job, Amazon Web Services, and along the way, kept syndicating deals, kept sort of working climate, and left Amazon to kind of really double down on this career in investing, and have been in there ever since. And started off sort of leaning more into the non-climate world because that's what was investable. But in 2018, I was like, okay, this feels investable. I actually bought Climate Capital as a domain in 2015, but didn't do anything with it because it wasn't anything to do with it. And then 2018, I'm like, okay, I think there's a there now. And so that's when I actually recruited you all to take over what I built in the non-climate world. And then we sort of launched DVC so that I could launch Climate Capital. And fast forward 2020, 2021, I really focused on climate. And that was more than the 1 minute, but here we are.
You deserve more than 1 minute. You're a Renaissance man, and was not trying to make it a minute because the journey you've been on is so tied and yet diverse. Like everything's tied to each other and yet it's all very diverse. Like anything from a pilot movie to a book to, I'm sure even acting has some thread through to what you do today. And I think it's incredible to, see people of your sort of tenacity and risk-taking capability. Just there's a comfort with risk that you have that I sit with too, that I don't think a lot of investors actually are comfortable with.
Yeah.
I don't know how they do their job, but they do it in a way that's actually constantly mitigating risk, but you see opportunity. And yeah, go ahead.
Three comments. One, it took my dad a long time to get comfortable with this risk, right? Like he, of course, being the traditional South Asian father and my mother. So there's a little bit of this dance with my parents for them to kind of trust that it was going to be okay, which, I think hopefully has finally happened. Second is a lot of smart investors will say, look, we don't take risks. It's all calculated. And the third thing I'll say is, and this is, I think, the difference between an early stage investor versus later stages. I say early stage investors invest in possibility and
Yeah.
growth stage investors invest in probability. And it's just a different calculus, a different math. And so, yes, it is riskier. But so much of what we do at the early stages is like, is this the right founder? Is this the right market?
Yeah.
There are numbers, but frankly, it's so early, it's hard to really invest in those numbers. It's really about, team, market, et cetera.
Yeah. No, having actually invested with you, I can say that you do that, and I was doing that on my own in my own like small way, and then when I joined you all, I felt validated that like, oh, this is about betting on people. Yes, there's a thesis about the opportunity and the industry or the trends or whatever, but what we're really betting on is this person. And it was so fun to see you in action and learn from you. So thank you for having sort of done that journey on your own and then sharing it with us as we all came together. So today you're investing primarily in climate. I guess tell me a bit about what you focus on. And when you talk about climate capital, I know it started and there was also an accelerator. So like it's been many things, but today, what are you focused on? What would make a company like a climate capital fit?
Yeah. And it was Silicon Climate that was the nonprofit accelerator that story arced to closure, and then Climate Capital, the firm, began in 2018. Hopefully quick version of that story is we started off as a syndicate at AngelList. And then AngelList launched something called Rolling Fund, which allowed LPs to invest as little as $5,000 a quarter into this fund, and that gave me reserve capital. Actually, I did two sort of micro funds, and I did this Rolling Fund, and check size was 10 to 50K, and still at 10 to 50K from that. And then a couple years ago, we as a firm launched our first fund, Climate Capital Bio, which has since spun out, and they're now called Juniper. And then last year, I guess the end of the year before, we launched Climate Capital Seed, which is sort of our next traditional fund. And spoiler alert, we're actually spinning that out as well into a new firm, partially because one thing we've realized is today Climate Capital, which for those of you who don't know us, we're one of the most active investors in the world. We have one of the largest founder communities. We have over 450, I think, portfolio companies. We have over 3,000 LPs, in our community. We've done events at Know Your Climate Weeks, at LA Climate Week, SF Climate Week. We're very active in the ecosystem, and we look at ourselves as a sort of connective tissue, not only from founder to capital, but founder to founder and founder to other investors. And because we've done so much, we have our own podcast, we have a newsletter, we have an angel program. People, when they were encountering Climate Capital Bio, they're like, what is this fund amidst everything that you do? And we sort of hit the same thing with Climate Capital Seed. And so we've realized that the proper funds probably should sit separate from the brand that is Climate Capital, so that they can each sort of do what they do best, right? Fund, maximize returns, small portfolio, et cetera, et cetera. Platform is different, right? We have a different goal, we have different aims. I'm not sure if that answered the question, but that's kind of where we are now, is reconfiguring where we are to be not just for this new administration and sort of terminology changes and focus changes, but also just like in the market, how the market perceives us, like shifting things to be, I'm not gonna say future proof, but at least, good for the next several years until we iterate again.
Yeah. So what kind of deals do you focus on now? Is there certain industries you tap into? Is there a stage that you guys sort of is your sweet spot, and check size? Tell us
Yeah.
about check size.
So we do have these different vehicles and they each have different areas, right? So I'll put Juniper aside. So we still have the syndicate. The syndicate, we have a group of folks who, just like we recruited you, for DVC, we recruited some incredible people to run SPVs, and they have different backgrounds, right? So we have someone who's deep in ocean. And so I don't know anything about the ocean, but it's just what she owns and knows. And so we've done some ocean SPVs, for example, right? Or someone else on the team, their expertise is residential. So he runs those. So every person on the team has their sort of domain of expertise, and they run deals in those areas, and it spans a gamut, right? Anything the climate touches, we've probably run a deal on, at least one.
Oh.
The micro fund is the same broad thesis. Now, for the SPV's check size, it's about 100. I mean, it's 50 to, the largest was almost $1 million. But in this market, let's just call it 100 average. For the micro fund, it's still kind of in that 10 to 25, very rare 50K check, and spans a gamut. Those same syndicate partners who have areas of expertise, we'll lean on them for diligence, right? If they're running an SPV, we'll be like, okay, this is your area. How bullish are you? How much are you investing personally? Why should the micro fund invest? And so the micro fund, from an activity perspective, we do 10 to 20 checks a quarter, and sort of each one is its own little basket and a little portfolio. The seed fund check size is about 100 to 150. We've only done 8 deals in 18 months. This is sort of like much stricter on valuation cap, much strong preference for nothing north of 50 posts. The pre-seed, as much as we look at those, we often are not investing from the seed fund into pre-seed. We'll do that micro fund to build a relationship, just because we're trying to design the fund in a way that maximizes returns like funds should. So we're just a little more strict about how we approach deals.
I love that. Are there any areas that you found that you're investing more in or less in the climate, through the seed fund in particular, or even the bio fund, just focusing on the climate conversation? What are areas that you guys have been seeing opportunity?
I think short answer is it changes, right? Like right now, like if you look at our seed fund, it's very, not to use an overused term, deep tech oriented. And I think the reason for that is, while we've invested across categories, from energy generation to energy management to ag to home electrification, the theme through them all is that they're very technology oriented. The founders are technical. The solution that they're bringing to market is technical. And the one that is, through the exception, which is copper, it's a technical founder and they're sitting on some IP. So even though you think of it as, oh, that's not a deep tech company, like behind the scenes, it kind of is. And even then they've got other things that make it defensible. I mean, that's probably what sort of pushed us to focus on deep tech is defensibility. One of the things, zooming back, like when I was first investing in climate 2015, and 2015, 2018, I still did climate. I just sort of did it as just a deal under DV. Mosaic was my first deal in 2015. But there were so few climate founders and so few climate investors that it was very crowded. And so there, you could sort of see, you could invest in a software company and not overthink defensibility because no one else was doing it. Then what happened is you had this flood of capital, flood of founders that came in, and it was amazing. It's amazing for the world. But all of a sudden, things that felt defensible a year ago were no longer defensible. And so from a sector perspective, it really narrowed what we were able to focus in from a type of company, sort of such that today, like, not that we won't invest in a software company from the seed fund, but we haven't yet, right?
Yeah.
Because we just find that there's just a lot of capital and founders, and we're really struggling to sort of see that defensibility to breakaway velocity, right? So for the seed fund specifically, again, on our website, we still invest across categories, but what's the thread through them all is technical
Mm,
solutions to opportunities that we think are big and growing.
mm. I wouldn't have known that. So that's super helpful. Are there examples of some deep tech climate deals that you've done that kind of represent the type of deal that you might go after?
I'd say just check out the portfolio. Look, I'll talk about one that's on our website that's public, right? So uh, Near Space Labs, right? They are geospatial intelligence. There's a lot that you can do, and with imaging, there's Planet and some other sort of, I think, multi-billion-dollar businesses that are in sort of the imaging space. But once you get out into space, like it's expensive to get up there, and there's sort of challenges, and so there's near space, right, where you don't quite go into space. The challenges today is how do you get things up there, in a cost-effective way, in a way that
Mhm.
is repeatable and that you can kind of have the accuracy that you want and need. And so they've been at it for years, and we're just lucky to come in on this most recent round where they've solved for that. Right, they have now
Mm,
a technology that gets you that, like, the cost to deploy is much less than to get into space. The accuracy is higher than space. They have a repeatable way to do it. They can deploy quickly. They can recover the devices, and so there's a lot of technology behind that, right? What do you think is a crowded space of imaging, right? You've got planes over here, you've got satellites over there, and they kind of sit in between with this sort of unique approach that has, broadly failed previously, but they've figured out a way to make it work with
mm,
a heck of a lot of tech, right? And so
yeah.
I don't know if that's deep tech, but it's definitely technology oriented, right?
Yeah.
From that
Yeah.
to nuts,
Hardware.
from the
Yeah.
device to the imaging, the AI, like everything around it, right? So that's
Yeah.
one example. There's another one called Avalo, which is in the ag space. It's advanced crop evolution through, and this is AI. It's a gene platform. How do we make crops more resilient, right? In sort of a
Mm,
changing climate. And this is one where it is kind of AI based, but there's a real world application, right? So it's not just software that's sitting that maybe someone else can rebuild, right? There's a lot of atoms involved as well, which we think makes
mhm.
it more defensible. So those are just two examples of the eight.
And as you think about the future of ag, like you just described, or just
Yep.
like better imaging and in this all of this in favor of a better planet, like what is the future that you want to live in? Like what does it look like when your portfolio companies have achieved success in the next 10 years? Because I want it to be sooner, right? I don't want it to be longer.
Right.
Like what are the things that are solved? What are things that are truly different because you guys put a check in?
Wow. So I'll answer specifically at what we put a check in because the more broad question, there's so much happening. Uh,
Yeah.
you know,
Yeah.
if you talk about climate capital, right, specifically, we are um, a word that again is overused, but resiliency, right? Like,
Okay.
energy resiliency now means something different. It's how to with sort of growing demand for energy. How do we
Mm,
should we have enough energy to do the things we need to do in but clean energy, right? Not just
mm,
let's go burn some more coal, right? Or adaptation for food, or it's the thing about climate is it is so broad, and so what I want is a world where we're just doing less harm to our planet and to ourselves, right?
yeah.
And so we're hopefully investing in companies that are enabling us to do less harm.
Um, awesome. Thank you. I too want to live in that world. And so when I see you making these investments, like for me, I'm just constantly like, thank you, right? Like, thank you for committing your time, committing your resources, your energy to this, because man, we're moving in a direction that isn't healthy and isn't gonna, we're not gonna sustain. And we all can't get on a spaceship and go to another planet. Or maybe we can. Um, is there anything about today, for me, primarily investing in also deep tech, but not specifically climate, but software, et cetera, like I'm sucked into this world of AI. I'm curious for you in where you invest, are you having the same sort of exuberance around the intersection of climate and AI, or is it kind of like business as usual?
Yeah, I think it's definitely something that's being discussed and being invested in, and there is defensibility, right? I don't want to sort of write off a whole sector, but I'm, so my AI cred, which is weak, I started working in AI in '97. My Stanford computer science project was I actually got to email with Tim Berners-Lee. I was working on like intelligent agents in 1997,
No way.
and then at Amazon. Oh, the first company I co-founded was an AI company
That's
in
right.
2007, right?
Was that Rich Relevance?
Mhm.
Yeah.
And
Personalized
then,
shopping?
yeah, I mean, with my co-founder who helped build people that bought this, bought that at Amazon, we kind of rebuilt it in a way, then deployed it to Sears and Target and all these other Walmart, I think,
Wow.
companies. And that was, machine learning.
Yeah.
And then at Amazon Web Services, I was, bridging the startup team and the AI team. And
That's
um,
right.
I actually led our involvement with OpenAI. Sam stopped me at an event, was like, I'm going to talk to you, and was able to kind of lead sort of our relationship there back in the day.
Sam.
Altman. Yeah.
Okay, just checking.
Yeah. So my point being, like, I've been in AI for a while, and I
Yeah.
do worry about a lot of capital being deployed as, I don't know. I think there's a lot of, unfortunately, companies that are just not going to make it, right? Because things are moving
Totally.
so quickly. And I think it's really hard to sort of get to that breakaway velocity. And in climate, I think that's true as well. That said, of course it's exciting, right? Of
Mm.
course, I talked about Volo, Near Space Labs using AI. Like AI is, there's two ways to look at it. One is it's embedded in everything, right? All the companies we're investing in are using AI to help
Mhm.
them do what they do, and that is AI and climate, right?
Mhm.
And then there's companies that are leaning more into what AI can do, and they're considered a climate/AI company. Are we looking at it? Yes. Uh, do we find ourselves like, oh my gosh, climate AI is where we got to focus? No, right? Because uh, there's still a lot of stuff happening in atoms, that
Mm.
we get excited about as we talk about defensibility. Again, we do worry about hype cycle around AI.
Yeah.
Uh, but the good news is, and this is one thing I'll say about climate capitals, are very collaborative, right? There are a couple of firms we work with who are leaning into that thesis. We've actually co-hosted an event with one of them around this topic because, again, there's the there. And so we collaborate, we talk, right?
Mhm.
Especially when a deal comes in, we're like, why is this going to work? Why is it not? And so it's not just us in a vacuum trying to decide, is this the climate AI company to bet on? It's these conversations with these investors that we co-invest with who have developed more of a thesis. In fact, I think Climactic has it's a map you can kind of Google on like the AI climate landscape to give them a
Oh.
plug. Yeah, and I give them a lot of credit for leaning in because it is exciting how AI can accelerate our solutions to this opportunity and problems.
Mhm.
But I personally, and we as a firm, don't put a flag in and say this is what we're most excited about because it's one of several categories we look at.
Yeah. And my understanding too is you're founder first investor.
That's right.
Talk a bit about that. What is the ideal sort of founder profile or, what do you look for when you say I'm leading with the founder in mind?
Yeah. It's it goes back to that possibility and probability, right? Like, we meet a founder. Is this the founder for this opportunity? What is their background? Why are they the founder to build this? Do they have the right temperament, right? And sometimes they don't, but do you think they can grow? Do you
Mm.
think they can attract the people to sort of round out their skill set? And especially since we're talking about technical solutions, like not just were they working at the company, but what do they do? Like, what is their
Mm.
technical ability in the domain that they're executing in? Uh, should do, your standard reference checks, and we have them meet multiple people on the team because so much is this the right person to build this? And that's the possibility, right? It's hard to really quantify it.
Yeah.
It's more just looking at their background, hearing them talk about their solution, poking, prodding, and seeing if they really have the depth of knowledge we think to execute on their idea.
Yeah. Um, I'm gonna go back because I wrote this down and I was like, what's he talking about? Someone who's not in climate, you said there's a lot going on in atoms.
Yeah, I mean, the concept of the real world, right? Bits and atoms, right?
Okay.
Like,
Okay, this
yeah,
is
yeah,
something I don't know.
yeah. Yeah.
Okay, nothing to talk about there. Is that correct?
Just real world, right?
Just the
The
real
real world,
world.
it's harder to build stuff in the real world, but that also makes it more defensible, potentially.
For sure. For sure. For sure. Yeah. And okay, so on that point, if you feel like you're leaning more into atoms over bits, do you find that your deals are more capital intensive, take longer to realize outcomes, and or have a different set of co-investors because everyone that you and I know from the beginning of our career are software investors?
Yeah, no, it's a great question, and a question that I think often comes up and scares away some people, right? When you're talking about
Yeah.
real worlds. Look, It is definitely cheaper with our margin to scale a software, pure software company. But then again, that's also why you have a lot more entrance and capital and competition, et cetera, right?
Right.
Uh, the good news is there are capital sources stepping into the void to help these companies. Now, for a while, you had government stepping in. You have now other institutions kind of stepping in that are expanding into, look, there are, and they're not doing it as charity. They believe they're profitable ways to debt finance or otherwise project finance in unique ways. Some of these companies that are at that sort of proof of concept, they've proven the concept. They're not quite ready to go out and raise a massive debt round to like scale, but they do need to sort of cross the chasm from like, okay, we have something we think that works. Sometimes they will raise some more equity, right, which is expensive to get to that next level. But sometimes it's a mix, right? It's like a little bit more equity than there's a grant involved. Maybe it's not a government grant, maybe it's something else.
Yeah.
And that's that capital area. It's a well-known secret. Like everyone knows that we do need non-venture capital available to help some of these companies that are operating in the real world execute to the point where then they can go and raise the massive debt to really scale.
Mm.
But whereas 5 years ago, there weren't a lot of options, or at least I didn't see many. Now there are more,
Mm.
government funding notwithstanding.
One conversation we had with Aryan, who was part of our crew at DVC, was that, everyone has this conception that hardware takes a long time to get to market. But specifically right now, because it's actually the cost to create the software that goes along with the hardware is calmed down, and hardware components are easier to come by just because of pure innovation, that the cost actually has come down, and so has the time. And I'm curious from
Mhm.
your perspective, does that, I mean, he's in the AR, VR, immersive space from a
Yeah.
hardware standpoint, and you're obviously in a different perspective, but
Yeah.
does it apply to you? Have you seen that shift? Because you've been in the space a long time.
Yeah, I think one of the things that there was a sweet spot sort of developed in the last few years, at least from my perspective, where folks are using a lot of off-the-shelf hardware, right?
Yeah,
And so there is innovation at the software layer about how that hardware interacts, or
right.
some innovation at the hardware layer, but it's not like you vetting the thing soup to nuts. It's like there's a hardware innovation and there's a lot of off-the-shelf hardware that comes along, and that has helped a lot of companies become venture scale. Uh, uh, and are, some are doing quite well,
Mhm.
raising B's and C's because sure they are, it's a hardware piece, but there's so much of it is actually software, right? Uh,
Mhm.
so yes, short answer is we are seeing
Cool.
hardware doesn't necessarily mean a long time these days.
It's more cost efficient in your mind
Correct.
too.
Yeah.
Yeah, I think like my view has been the same, that I feel like we're coming actually to a hardware renaissance because to your point, software has become saturated. And I think we're going to have more things, physical things that are smarter and more effective and more useful in our lives than ever before, which, and hopefully that doesn't lead to more waste. But side note on creating physical things, though, the other complexity is supply chain. So I'm curious, in your portfolio, have there been, complete like rundowns of companies because of supply chain in terms of getting components, or is that mitigated in ways that I don't know about?
Yeah, not yet. And again, while we have a massive portfolio, I don't know them all, right? We have people who run syndicates, and I don't even know some of the
Right.
companies I'm invested in. And we have micro funds where they're owners, so I didn't really talk to the founder, someone else led. So, the ones that I'm most focused on are our seed portfolio and some of the more recent checks that I wrote. And for
Yeah.
them, I haven't heard any companies shutting down because of supply chain, right?
Yeah.
If there are issues, they're being addressed. They're being thought through. I was actually moderating a panel a couple of days ago with someone from Galvanize, which is a well-known and massive climate investor at the growth stage, and they're talking about, look, what's happening in the world is just causing founders, the ones are hopefully setting up to win, to just do a lot of scenario planning, right?
Hmm.
It's not necessarily freaking out. It's just like, okay, how do we start
Hmm.
in a way to just make sure that if this happens or that happens, we're prepared. And what's happening is, borrowing what he was saying, because I haven't seen this myself directly, is some of these founders are realizing that there are other markets that perhaps they were going to not go into for a while that are maybe more attractive to expand into sooner, right?
Hmm.
Because maybe supply chain or market changes or tariffs or what have you. And so there is sort of in this, to the extent you're talking about supply chain disruption and tariffs, and
Yes.
there
Yes.
is
Yes. Yes. Yes.
like opportunity as well. Amid the chaos where founders are like
Yeah.
seeing, okay, things have changed. My execution path needs to change. So let's do sprint planning. And oh my gosh, I didn't realize, because I didn't think we had to look in here, that this actually may be a better way to execute in the near term. And so
That's so
And that's
cool.
right.
Yeah, I love the idea that there's opportunity in chaos because, when things get hard, the people who don't have it in them, they fall out. And so you're left with the soldiers that are ready to fight. Speaking of challenges, tariffs, you are in a space that is in the crosshairs
Yeah,
of the current administration.
sure.
Um, what does this mean for you? What are you thinking about? Is there opportunity in the chaos?
Yeah.
What are you seeing?
Yeah. So uh, I think the word climate uh, is not as attractive as a word for investors and as it used to be. Uh, but what we're investing in, the companies we're investing in, are still solving important problems in massive areas, right?
Yeah.
And that hasn't changed, right? These
Mhm.
problems still exist. The opportunity's still there, and it's just maybe there's a rebranding. Another panel I was on or at for Climate Week, SF Climate Week just is going on right now.
That's right.
Van Jones spoke, and he was talking about like terminology, and actually Paul Hoffman was saying the same thing. They're both saying that terminology matters, words matter, and Van Jones was talking about like we just need to rephrase some of these things and not be so like college education vocabulary. Like, don't talk about resilience. Like, what does resilience mean? Right? Talk about like we have dirty water and we need to clean up the water. Right? Just say things.
Name it.
Just yeah, in as basic terminology and just be specific. And then no one's going to argue with like cleaning up dirty water. Right?
Yeah.
No one's going to argue with like, hey, we have too many fires and we do a poor job. Like fancy words like resilient and frankly, maybe even climate. In other words, drop those and speak to what you're actually building. And so the point being is like, look, not much has changed. There's
Yeah.
still incredible founders building incredible companies. Problems are still there. It's just a little bit of shifting around how these problems are framed and the solutions are discussed. That's it.
I could not agree more. I think we also have to acknowledge that the way the system we're in right now is full of a lot of um, chaos creation, but not necessarily like that it lasts, right? It's just there to create some noise and then we move on.
Yeah.
And so I think irrespective of that, like disruption,
Yeah.
using the right language, I think is super important. And I love the idea of simplifying for
Yeah.
reality.
For the acute, listener, I shouldn't say that's it. Like, yes, there's a lot of disruption happening around like, funding drying up, grants because there
Yeah.
is a lot happening and that is undeniable and unfortunate. And certain sectors are less investable, right? Because they're more cloudy. But a lot of the sectors, uh, we're still going, we're still executing. It's just some reframing. That's and the vast majority, I would argue. So that's kind of what I was saying is like the vast
Yeah.
majority, it's just reframing and let's go. Despite these massive changes around potentially financing from the government
Mhm.
and certain categories, frankly, just not being attractive with this new administration.
Are there more private sector solutions for the funding drying up? Is there any other things that are happening that we should know about that are hopeful?
Um, a lot to be hopeful for. One of the things being a lot of these investors raise money before the administration. And so
Mhm.
we have a lot of funds that are sitting on a lot of capital that needs to be deployed. And the investors I talk to, they're not changing. I literally asked the question because I was moderating the panel. I'm like, is anything changing about your thesis?
Yeah.
And, it was a sample size of 3, but they're like, no, not at all. Right. And I imagine that's the case for the vast majority. You have some generalist firms that are backing off a little bit,
Mm.
who were maybe attracted to climate for whatever the reasons were. But the folks who've raised a lot of money specifically to invest in climate are still investing in climate, and that is hopeful, right? Because
Yeah.
that means no time soon, to my knowledge, is capital going to be drying up for venture investments. So, hey, founders, bring us your ideas. There's still a lot of capital to help you build what you're going to build.
No, yeah, totally. And to speak from someone who's not a specifically climate investor, but a generalist, two of our climate-ish companies, one that does energy storage called Cash and one that does alternative protein called Plantable, both successfully raised Series Bs at perfect, wonderful valuations. Yes, it was hard, but they did it. And so I
Mhm.
think you're right. Like out there, things are still happening despite the challenges. Okay. I have two last questions. One is you've made a lot of investments. Is there one in particular that stands out as like the worst investment that left you with a lot of lessons that you want the listeners who might either be investing or looking for investment know about so that they don't make the same mistakes?
Yeah, I think I'm not going to name the company, and this one was borderline climate. I think the worst investment that I made is where I felt misled by the founder around how the round was coming together, and they shut down like 3 months after I invested. And I was like, "What are you talking about? Like, didn't you just tell me all these investors are coming in?" And he just and I thought I'd asked maybe, I don't know, like when the capital came in or how much was being invested. And that's just a burn, right? It's like, that's on me, right? Like, clearly I didn't do the diligence.
Yeah.
I needed to avoid that. Thankfully, it was a small 10K check out of a micro fund that made a lot of other investments that quarter. So, LPs will be just fine. But that burns the most, right? And so, not just asking about runway. Um, uh, there's some lessons around that, right? Like from a
Yeah.
diligence perspective to how to avoid that. Because
Mhm.
you sometimes, right, you get so caught up in the founder. I get so caught up in the founder, and they come into their trusted thing, and probably there's all this signal around why this founder is going to build something massive.
Yeah.
That sometimes a very important question, doesn't get asked, or
Mm.
very important detail around like when capital was actually raised doesn't get asked, or what have you. Um, that's probably the one that stings the most. Beyond that, again, yeah, to your point, like, as a portfolio, we have over 450 companies. So I did this math in early February because someone asked. At the moment, we had 439 portfolio companies. We'd had in early February 7 exits, and only 17 shut down. And of the 17, two returned majority of capital because the founders quickly realized they weren't building something venture scale in return. So just call it 15 zeros. Uh, so of the 439, 415 are executing. Like, some are on the ropes, to be clear, but we've been investing since 2015. Um, I think those numbers are decent, and for, again, most of those 15, the two that return a lot of capital aside, like, I can tell you why we invested, who we invested with, what the founders are doing now. I've actually reinvested in some of these companies as the founder is on their next version, and that's kind of like the founder didn't fail, the company failed, and now let's back this founder one more time, right? So be
Yeah.
it.
Wow. No, you are special. That is a very strong statistic that I don't think a lot of investors with that size portfolio can speak to. So good job. Let's wrap on your most proud investment to date. Maybe one where you've had an outcome or one where you didn't, but you're just like,
Yeah.
this is the one that I'm most proud of.
Yeah, yeah. It's my answer to this is always Mosaic. Not
Ah,
because, I still don't know how that story's gonna end. If you don't know Mosaic, they are
no.
a capital, just lender in solar.
Mm,
Uh, and the reason is because my first SPV, which was Mosaic in 2015, because when I left Kiva, I'd had an idea around, like, I had a couple of ideas because Kiva's a microfinance platform. I was like, what about microfinancing green job training? Or what about microfinancing solar panel installation?
yeah.
Dealing with it because I was co-founding Rich Relevance. But then when I met the Mosaic team, they were microfinancing solar panels. I was
Mm,
like, I love this. And the team was great. And so it was this perfect, like, I had something of a similar idea. You guys were way more qualified and smarter than me to execute on this. How can I be a part of it? I got to be an advisor there before I became an investor, and just to this day, love Billy and Dan so much
mm,
as humans. And, you know, again, I still don't know how the story's gonna end. It's not like my favorite investors for me, like, I made a bunch of money or whatever, whatever. Like, they've gone on to do quite well, but have also hit some challenging times. But just like my personal relationship with that idea, that experience, and then being my first actual SPD,
mm.
like, that's why it's always my answer.
I love that. Oh my gosh. Sandeep, this was awesome. I want to keep talking with you, but this is a wonderful time together. So many stories that I hadn't heard. So thank you so much for your time. Hopefully, we'll
Thank
see you
you.
soon.
Absolutely. Thanks, everyone. Bye.
All right. Welcome back. That was another great episode. Hope you enjoyed it as much as I did. So typically, I listen to the episode as soon as we record it, take some time to reflect, do some thinking, do some writing, and share back my takeaways. Many of you have said how much you enjoy the takeaways, which I appreciate because this is why I'm doing this. I'm doing this to take the time to think and reflect and have my own thoughts about what other people are saying. So it's the real reason for doing all this is to have some takeaways. However, I'm going to change the format of how I share my takeaways. And there's two reasons for that. One is I want to hear from you. I love recording my thoughts, but it's also great to hear what you all think, the listeners. So, whether you're an angel investor, a venture capitalist, or a founder, I want to hear your thoughts too. If you agree or disagree or have new thoughts or have questions, I'd love to hear what those questions might be. So that's one reason is I want to be in conversation. I want to be in community with all of you listeners. The second reason is things are changing in a good way for me, which is going to make it harder for me to take the time out to come back on to record. It's going to be much easier for me to spend time writing and thinking and putting that out via our newsletter. And I'll share more about why things are going to get busy in the next week or two, but it's all good stuff. And I'm super excited to let you all know. So, with that, if you have not joined the newsletter, and I know some of you already have, thank you for that, please join. And once you do join, you'll only get messages after every episode, nothing else. But I invite you to share your thoughts with me or reflections, or even just like let me know if that was a good or a bad episode. I just want to hear from you all. I want to be in better connection with my community. So, with that, go to firstfunderspod.com and drop your name in the newsletter. I might have to manually add you because I know some of you listeners out there already, but please do that. And would love to hear what you think. Thank you again. Thank you for listening. Thank you for being a part of this community. And we'll see ya next time. Ciao.